going to be what I call the top 10 special loan programs. So the first, you may have heard me talk about earlier, with the conventional loan, you can go as low as 1%. Really, the minimum is 3%. But some lenders like UWM, for example, United Wholesale Mortgage, they are willing to match you. They say, okay, you put down 1%, we'll actually bring the other 2% to the table for you. The 3% is covered. They'll go up to $4,000. If 2% for your loan is above 4,000, it is capped out at 4,000. But even if you only end up doing 1.5% instead of 3, that's going to be saving you a ton of money, depending on the loan. So that's a wonderful option. The second is going to be the empowered DPA. DPA stands for down payment assistance. This means you have the ability to have a full 100% forgivable grant given to you to clear the full 3.5% required down payment for an FHA loan.
As they say, the president continues to call on Congress to provide up to $25,000 in down payment assistance to first-generation homebuyers whose families haven't benefited from the generational wealth building associated with homeownership.
And believe it or not, a lot of times, some wholesale lenders will only require you to have a 580 or better to take advantage of it. Other lenders may want you to have a 620 or better to take advantage of DPA, down payment assistance. And no, you don't always have to be a first-time home buyer. However, just like most of these too good to be true sounding loan programs, they are strictly for people under a certain household income level. So you can't make too much to qualify for a down payment assistance program. But for this one specifically, you just need to have a 620. Now let's talk about how you can actually buy a house and get pre-approved and fully approved for an FHA loan with scores as low as 500. Now, realistically, you're going to need more than just the 500. If you can make a 10% down payment and you don't have anything crazy on your credit report, right? Anything recent, like, a lot of late payments on a current mortgage or something like that, then yes, 10% down, meaning you are coming to the lender and you're letting them know, hey, listen, I understand that this is a risk because my credit score is a 533, but I'll bring 10% instead of 3.5%. And that's how you can actually get approved, with a much lower credit score on an FHA loan. You just got to bring more to the table to meet them halfway. Next, let's talk about job hopper loans. This is a name that I created, but essentially one thing you'll learn as well, if you ever go to a retail lender, they're going to require you to have consistent income at one job for a minimum 2 years. So even if you just got a amazing new job and you just accepted a job or you've been there for 6 months, there are some lenders who will just say, I'm sorry, you have to be at that job for 2 years in order for you to get pre-approved. Or if you have a job gap of a month or 2 or 3, oh, I'm sorry, there was a job gap, we can't help you. So this is for people who have changed jobs multiple times within the last 2 years. And it's also for people who, as long as you don't have a job gap, no more than 6 months, we can work with you. It doesn't matter how many times you switch jobs. We're just going to get all of those W-2s and then your most recent pay stub. And we're going to look at averaging that out to be whatever it is. And that'll be your qualifying income, which is really important because as a home buyer, especially going through the mass exit or whatever you want to call it, during the pandemic where a lot of people were quitting their jobs, a lot of people were laid off, and then now you're just looking for the best position for you. This is something that would be great for somebody like that in that situation. Now let's talk about bank statement loans. A bank statement loan is crucial for all entrepreneurs. Why? Because before you watch this video, you may have been watching a video where they're teaching you all these different ways you can write things off, and you can write off everything under the sun, right? When you're a business owner, according to, some YouTubers. But one thing you want to keep in mind is when you write too much off, you're literally lowering your income, your taxable income. That's what it's all about. So let's say you make 200,000, but you wrote off 150,000, which sounds crazy. Don't even know if it's possible, but I wouldn't be surprised. If you did that, it don't matter if you make 200,000. We're going to use the 50,000 that's left over after all of those deductions as your qualifying income to determine how much home you can afford. That's what the retail lenders would do. But with a bank statement only loan, it means if you give us the last 12 months to 24 months of your last bank statements, we can look at the total deposits and average that across the last 12 months or the last 24 months. And then we'll use that as your income. So that right there is crucial for the reason I just mentioned. The only caveat is, just like having a lower credit score, anytime you are considered more of a risk to a lender, they're going to want you to bring more moolah to the table. So in this case, at least 10% is what you're going to have to bring to the table as a down payment if you want to do a 1099 only, because we have those too, or bank statement only loan. It's just a part of the game, right? Give and take, meet them halfway, and they'll work with you. Now let's talk about a DSCR loan. This piggybacks beautifully off of the bank statement only loan. A DSCR loan is for purchasing investment properties. All right. This is where you're going to be able to use your income plus whatever you expect to get or earn from rental properties and rental income. And essentially, as long as your rent income or revenue covers your mortgage payment, you can do a DSCR loan. Now, some lenders are going to want to see that you're at 1.15% or 1.15 times your monthly payment. But if it's at least 1-to-1, meaning your rent will cover your mortgage payment, you could actually, be approved for a DSCR loan. And with the DSCR loan, you can actually purchase multiple properties with one loan. A very, very popular product for my investors. Now, jumbo loans. All right. Depending on where you live, I live in Georgia. So here in Georgia, a jumbo loan is any conforming loan above $766,550. Anything above that is a jumbo loan. And with jumbo loans, you're going to notice a pattern here. Because it is a higher risk, you're going to have to bring more to the table. Again, at minimum 10%, it could go up to 20% requirement for the minimum down payment if your credit score is below a 680. The minimum credit score needed for that is going to be definitely a 660. But if you have, let's say, a 680 or better, you can go as low as 10% down. Now, let's talk about manufactured properties, manufactured homes. These are homes that are like a mobile home, a modular home that comes in 3 or fewer pieces. And that is what a lot of retail lenders stay away from. But again, the wholesale lenders, we have FHA, conventional, and USDA products that you can use to purchase a manufactured home as long as it has that HUD tag. A double wide trailer on the back left, normally you'll see either a silver or red plate. And that is what we call a HUD tag. That means it's certified, and think about like a certified car, right? It's just them making sure that this is a good and well conditioned property. As long as you got that with a minimum 580 credit score, you can do a manufactured home loan. Next, we have doctor and physician loans. If you are a doctor or medical clinician or physician, you may not have known, maybe you do, but there are special residential loan programs that you can get that allows you to have no mortgage insurance, which is beautiful. Again, saving you hundreds of dollars per month. And then last but not least, you may say, well, why the heck would somebody do a 40-year mortgage loan? Well, if you're looking to buy a property and right now your DTI is too high, you just maybe 4 or 5% off from being, let's say the max is 50%, extending the loan payments from a 30-year term to a 40-year term can be the difference between you getting approved for this loan or the purchase of that property or you getting declined. You can always refinance later into, let's say, a 30-year, but a 40-year would at least allow you to have that backup plan if you meet all the other parameters, but you just need to lower that monthly payment so that the DTI comes down. You can do a 40-year loan with no balloon payments or no prepayment penalties at that. So those are what I call the top 10 special loan programs, some of them being non-qualified mortgages, which isn't bad. It just means that they have a lot more flexibility. So if anybody has any questions about any of these, right now would be a great time to ask me.